A Section 125 cafeteria plan is a written plan that lets you choose between at least one taxable benefit, like cash, and at least one qualified non-taxable benefit, like health coverage. That choice is the whole point. Without a proper cafeteria plan, offering a cash or benefit choice can trigger constructive receipt and make the benefits taxable. On the EA exam, that choice causes taxability idea shows up a lot. Here's the key exam hook. A cafeteria plan is basically the only way an employer can safely offer a menu of taxable versus non-taxable benefits. If the plan only offers choices between taxable benefits, it's not a cafeteria plan at all, and the plan can generally cover the employee, the spouse, and dependents. The written plan requirement matters. Informal, pick-what-you-want arrangements don't get Section 125 protection. Most cafeteria plans run through salary reduction elections. You agree to reduce your paycheck, and the employer uses that pre-tax amount to pay for qualified benefits. Even though it's pre-tax withholding, that salary reduction feature is typically enough to count as the taxable option because you could have taken the cash as wages instead. Practically, this lowers income tax and usually payroll taxes too, which is why employees love FSAs and similar elections. A quick example. Samantha works at a firm with a cafeteria plan. She declines the employer health option because she's covered on her spouse's plan, but she elects a dependent care FSA and life insurance. Her FSA contributions are pre-tax, so her taxable wages drop. That means less federal income tax, and typically less Social Security and Medicare tax as well. On exams, watch for the decline one benefit, elect another fact pattern. It's normal under Section 125. Now the big pitfall, non-discrimination rules. The IRS doesn't want cafeteria plans designed to reward only the top people, so employers test whether the plan favors highly compensated employees, called HCEs, or key employees, in eligibility, contributions, or benefits. If it favors them, the plan can fail testing. Large employers often pay for annual testing. Smaller employers may use a simple cafeteria plan if they have 100 or fewer employees, which can bypass annual non-discrimination testing. The exam also loves family attribution. You can become an owner for these rules just by being related to a 5% owner. Spouse, child, parent, or grandparent of a 5% owner can be treated as an owner too. That can push someone into HCE or key employee status even if their own pay isn't huge. So when you see a family relationship in the facts, don't ignore it. Assume the test writer put it there for a reason. So what happens if the plan fails non-discrimination testing? The punishment is aimed at the favored group. The HCEs or key employees lose the tax-free treatment and must include in income the value of the taxable benefits they could have selected or received under the discriminatory plan. A classic example is offering an FSA only to executives. Unless corrected, those executives end up with taxable wages for the benefit value. The rank-and-file employees aren't the ones penalized. What happens when an employer's cafeteria plan favors highly compensated employees or key employees in eligibility, contributions, or benefits? One option says the employer pays a 20% excise tax. Another says the favored employees must include certain benefit value in taxable income. Others claim the employer loses deductions or the plan becomes a prohibited transaction. Think about it. The correct answer is that the employer must include in the HCE or key employee's taxable income the value of taxable benefits the employee could have selected. That's the non-discrimination penalty. The favored group loses the exclusion. The excise tax answer is tempting because other benefit rules use excise taxes, but Section 125's consequence is taxable income to the favored individuals. All of the following statements about transportation fringe benefits for employees in 2023 are correct except one. The choices include: transportation fringes are fully taxable and must be included in wages. They aren't deductible by the business. They can be provided through a bona fide reimbursement arrangement, and they can be excluded from wages. Which statement is the exception? Think about it. The exception is the statement that qualified transportation fringe benefits are fully taxable and must be included in wages. Generally, qualified transportation fringes are excludable from wages up to monthly limits. A tempting distractor is the deduction rule. Employers often can't deduct these benefits, so people assume they must be taxable to employees too. But deduction limits and employee exclusion are separate concepts.